Have you ever stood at the edge of a vast financial ocean, feeling the cold spray of conflicting advice on your face, wondering if the map you hold is truly reliable? Many of us have been handed a compass called modern portfolio theory, or MPT, a framework taught in esteemed halls and whispered in boardrooms as the bedrock of rational investing. It promises to optimize, to diversify, to shield us from the market's fiercest storms. Yet, for some, the waters still feel turbulent, the promised calm elusive. This isn't about discarding wisdom outright, but about looking deeper, past the polished equations and into the often chaotic, profoundly human landscape of capital markets. We're told to diversify, to spread our seeds across many fields, and in principle, this resonates. But what if the very soil we're advised to plant in is less fertile than it appears? What if the modern approach, in its quest for statistical elegance, overlooks the very real, visceral anxieties of an investor, the sudden squalls of fear, or the relentless currents of greed that truly move markets? What if the carefully constructed models falter precisely when we need them most, leaving us vulnerable to the very unpredictability they claim to manage? Today, we begin a journey not to dismantle, but to critically examine the foundations upon which many of our investment strategies are built. We will gently peel back the layers of modern portfolio theory, revealing 9 fallacies that, if left unaddressed, can subtly mislead your most earnest efforts towards sustainable wealth. This isn't about quick fixes or sensational revelations. It is about seeking a deeper truth, a more profound understanding. Benjamin Graham, the quiet sage of value investing, once implored us to be intelligent investors, not merely conventional ones. He understood that true intelligence lay not in blindly following formulas, but in a disciplined, independent mind, anchored in intrinsic value and a robust margin of safety. He asked us to question, to think with clarity. So, let us ask ourselves, is your diversified portfolio truly diversified? Is our portfolio truly intelligent in Graham's sense? Or is it merely conventional, susceptible to the very follies it claims to mitigate? Are we truly making informed decisions, or simply following a well-trodden path that might lead us astray when the ground shifts beneath our feet? We are uncovering the hidden truths behind wealth accumulation, inviting you to don the mantle of critical thinking. Don't just invest, understand the why behind every decision. Let us together explore the genuine underlying mechanisms, distinguishing them from market noise and superficial analysis. Does the market ever feel like a relentless riddle, leaving you with a silent financial wound, a persistent ache of being outsmarted? This feeling can lead to a deep, philosophical questioning. Is the system truly rigged, or is our understanding fundamentally flawed? Modern portfolio theory, in its elegant framework, often begins with the assumption that all market participants are rational, utility-maximizing agents. It is a clean, predictable model, yet this common distortion ignores the profound impact of our human nature. We are not cold machines processing data. We are being swayed by confirmation bias, seeking information that validates our existing beliefs, and deeply sensitive to loss aversion, where the pain of a loss overshadows the joy of an equivalent gain. These powerful, often irrational forces drive both market exuberance and panic, shaping outcomes far more than pure logic alone. The shattered expectation for many is that market prices always reflect all available information. However, the counterintuitive truth is that human psychology, with its inherent biases, creates the very anomalies where true value is found. It is in these moments of collective irrationality that discerning investors can uncover what others miss. To navigate this human market, a strategic technique from behavioral finance is to regularly audit your own investment decisions. Take a quiet moment to step back and ask, am I acting on data, or am I reacting to a feeling? This conscious self-reflection helps identify and neutralize cognitive biases that MPT, in its focus on pure statistics, often overlooks. It transforms impulsive reactions into disciplined analysis. Consider the internal landscape. The reward of following the herd can release dopamine, a fleeting sense of security. But deviating, standing alone with a data-driven conviction, can trigger cortisol, the stress hormone. This neurochemical dance often hinders empowered, data-driven decision-making, trapping investors in a cycle of market underperformance, like a ship chasing mirages instead of true north. We must learn to distinguish the whispers of true value from the siren song of the crowd. The unspoken fear of financial loss can settle deep within us, particularly when a seemingly diversified portfolio still suffers significant drawdowns. This experience often leaves a feeling of inadequacy, pushing us to distrust conventional risk assessments that failed to protect our capital. It begs the question, what is risk truly? Modern portfolio theory champions a pervasive distortion, equating volatility with risk. This narrow definition, though mathematically convenient, often blinds investors to far greater dangers: the true risk of permanent capital impairment and the silent erosion of purchasing power over time. Price fluctuations are but the market's heartbeat. They are not inherently a threat to a sound business. Here lies a counterintuitive truth. A temporary temporary price decline in a fundamentally strong business is not a risk to be avoided, but an opportunity to be embraced. This shatters the MPT-driven expectation that all market swings are equal threats. Benjamin Graham taught us that volatility can be our friend, offering chances to buy good businesses at bargain prices, much like a patient gardener waiting for the perfect season to plant. To truly protect your capital, consider a two-step risk assessment method rooted in value investing principles. First, discern the true business risk, evaluating competitive moats, management quality, and financial health. Second, distinguish this from mere market price volatility. This approach enables a margin of safety that MPT's beta, focused purely on historical price movements, simply cannot provide. It's about understanding the underlying asset, not just its daily ticker dance. The story of George Soros and his reflexivity theory beautifully illustrates this. Soros understood that market prices don't just reflect fundamentals. They actively influence them through human perception and behavior, creating powerful feedback loops. He treated the market not as a predictable machine, but a complex, self-referential ecosystem where human beliefs and actions constantly shape reality. This reveals the critical importance of understanding these dynamics over static quantitative risk measures. Are you ready to see risk beyond the numbers, to feel the pulse of the market's true nature? The mantra diversify, diversify, diversify echoes through financial advice, often preached as dogma. Yet, for many, this incomplete financial education leaves a lingering frustration, a feeling of diluted returns and false security. We are told to spread our capital wide, but without a deeper understanding of what to diversify across, and why. This broad scattering can become a weakness rather than a shield. The myth persists that simply owning many assets guarantees safety. This belief obscures a critical reality. True diversification lies in uncorrelated risks and intrinsic value, not merely a broad basket of market-correlated securities. When the tide turns, many seemingly different assets often move in lockstep, revealing the superficiality of such a strategy. This leads to a shattered expectation that a highly diversified portfolio inherently reduces downside risk during systemic crises. The counterintuitive truth of crisis correlation teaches us that in moments of true market stress, everything can move together. The carefully constructed layers of diversification suddenly collapse, exposing the fragility of a strategy built on quantity over quality, leaving investors vulnerable when they most need protection. Instead, consider a strategic technique for focused diversification. This approach integrates a deconcentration on high conviction, genuinely understood assets, businesses you know intimately, whose intrinsic value you can assess, with carefully chosen, truly uncorrelated hedges. This is rooted in rigorous fundamental analysis, far beyond mere asset class allocation. It's about building strength through understanding, not just spreading thin. Society, in its haste, has often distorted the image of the independent, data-driven investor, subtly pushing them towards generic, over-diversified portfolios that promise an average outcome. But why settle for average when you possess the capacity for profound understanding? Imagine a master chef curating a few exquisite ingredients, knowing their origins, their flavors, their perfect harmonies, rather than simply presenting a buffet of mediocre options. We are invited to cultivate a robust, concentrated portfolio of exceptional businesses, to truly know what we own, fostering a quiet confidence that MPT's broad strokes cannot provide. Are we truly seeking average, or are we ready to cultivate excellence? The sheer volume of financial information can be overwhelming, often without clear synthesis. Many investors wrestle with reconciling MPT's short-term statistical models with their own deep-seated, long-term wealth-building aspirations. This internal conflict often leads to analysis paralysis and, subtly, missed opportunities. How can we truly build enduring wealth if our framework constantly pulls us back to the immediate? Modern portfolio theory often falls into a common distortion, prioritizing short-term variance minimization in portfolio optimization. While mathematically elegant, this approach often overlooks the profound long-term impact of compounding intrinsic value and the quiet, undeniable power of patience. It's like judging a marathon runner by their sprint speed in the first mile, rather than their endurance and strategic pacing over the entire race. Here is a counterintuitive truth. Much of the market noise, the daily fluctuations MPT obsesses over, is largely irrelevant for genuine wealth compounding. In fact, this constant chatter often distracts us from the quiet, relentless growth of underlying business earnings. This shatters the expectation of constant optimal rebalancing, suggesting that sometimes the best action is no action, allowing the seeds of good investments to simply grow. Consider a three-step wealth management technique to shift your focus from MPT's short-term statistical efficiency to a more profound, long-term value efficiency. First, identify businesses with enduring economic moats. Second, commit to sustained capital allocation to these compounding machines. Third, cultivate the patience to let them mature. This approach emphasizes the inherent strength of a business over its momentary market sentiment. The story of John Bogle, the pioneer of index investing, reveals a profound truth about the discipline required for long-term wealth accumulation. While his approach differs from value investing, his emphasis on patience and minimizing intervention offers a powerful contrast to MPT's active rebalancing. Imagine planting a mighty oak tree. You nurture it initially, but then you let it grow, rather than constantly digging it up to check its roots. This is the essence of true long-term investing, identifying the right assets and allowing the magic of compounding to unfold, undisturbed by the fleeting concerns of the short term. Are you willing to embrace the long game, to truly let your wealth grow? There's a philosophical wound many of us carry, a quiet questioning of the market's fundamental fairness or logic. We are taught to lean on historical data, to trust its patterns for protection, yet time and again, it seems to offer little defense against true black swan events. It leaves us wondering, if the past doesn't reliably predict the future, what compass can we trust? Modern portfolio theory often rests on a common distortion: the belief that historical market data, particularly return distributions, are reliable predictors of future outcomes. This is a profound oversight, ignoring the fatal mistake of assuming past normality guarantees future predictability. The market is not a static pond where ripples always behave the same way. It is a dynamic, ever-evolving ocean. This leads to a shattered expectation that quantitative models, meticulously built on historical averages, can accurately forecast future market behavior. The counterintuitive truth is that market regimes shift. What worked in one decade may fail profoundly in the next. The often dismissed phrase, "this time is different," sometimes holds a crucial kernel of truth, urging us to look beyond the rearview mirror. So, how do we prepare for a future that refuses to mirror its past? A practical framework involves scenario planning and stress testing your portfolio, moving beyond MPT's reliance on historical standard deviations. This means incorporating rigorous macroeconomic analysis and critical theory, imagining and preparing for non-normal market events, rather than assuming they won't occur. It's about building resilience, not just optimizing for an idealized past. The analytical skeptic eventually understood that MPT's elegant equations were often built on the assumption of a static, predictable world. It was much like a meteorologist predicting tomorrow's weather based solely on yesterday's average temperature, instead of accounting for the dynamic, chaotic forces of the atmosphere. The market, like the weather, is influenced by countless variables, human emotions, and unforeseen currents. Are we merely looking at averages, or are we truly seeking to understand the dynamic forces at play? We have journeyed together through the intricate landscape of modern portfolio theory, gently dissecting its core assumptions, not to discard, but to understand. Perhaps, in this exploration, you recognize the quiet frustration of feeling overwhelmed by conflicting information, the fear of making costly mistakes, or the uncertainty of building sustainable wealth beyond basic savings. It's a profound pain, this struggle to translate complex theories into actionable, profitable strategies, and it often stems from frameworks that, while academically sound, sometimes disconnect from the raw, human reality of markets. We have revealed how MPT's reliance on rational actors often ignores the profound impact of behavioral biases, how its definition of risk can mislead our capital protection, and how its broad diversification can, paradoxically, dilute our strength. We've seen how short-term models can sabotage long-term aspirations, and how a blind faith in historical data can leave us vulnerable to the truly unforeseen. These are not mere academic debates, they are fundamental shifts in how we approach our financial lives, demanding a deeper introspection. The path to sustainable wealth lies not in blindly following any single academic model, but in cultivating a critical, data-driven mindset that prioritizes intrinsic value, understands behavioral realities, and embraces the wisdom of those who have navigated these waters with profound success. As Warren Buffett famously observed, with a quiet certainty that cuts through all market noise, risk comes from not knowing what you're doing. This profound truth invites us to move beyond superficial analysis. By challenging the conventional wisdom of MPT, you are not rejecting wisdom itself. Instead, you are embracing a deeper knowledge, seeking a more robust foundation for your financial mastery. Imagine yourself as an architect, not just accepting blueprints, but understanding the very soil, the materials, and the forces of nature that will act upon your structure. You are building not just a portfolio, but a sanctuary of financial independence, brick by meticulously chosen brick. This is a continuous journey, a sacred practice of introspection and rigorous analysis. Take a moment, breathe deeply, and gently audit your own beliefs. Where might your current strategy be subtly misled by assumptions you haven't questioned? What underlying truths are waiting to be uncovered in your own financial landscape? Are you truly building with intention, or are you merely following a well-worn path that may lead to an uncertain destination? Challenge the consensus. Find your edge.